everyone. Good morning, good afternoon, good evening. Thank you for joining the first quarterly Q&A of 2022 from Mayar Capital. We'll be joined by Aziz and Aubrey from the investment team, and we have some material that we'd like to present during the course of this session. But to those that have joined for the first time, the session content is really generated by you, the audience. We've had a number of questions submitted ahead of time, and we're going to get to those over the next few minutes. But also feel free to ask your own question through the Q&A session. This session is also designed to be around 30 minutes long, although sometimes we do creep over that. If we don't get a chance to answer your question today, we will certainly follow up with you in due course. But for those who are just joining now, please feel free to use the Q&A session. I'll be able to see those questions. You'll be able to submit them anonymously. And if we get questions on the same subject, I will try and combine those into one question to make the best use of time. We'll see that Aziz is in the offices at Mayar as well. We've got Aubrey joining from his home office as well. I don't think you can see him at the moment, but when the time comes for him to speak, you'll see him and his office in all its glory. So we're all looking forward to that, I am sure. So we'll get on to the first questions. Question one. To Aziz and the rest of the team, could you give an account of what your lessons learned were from last year, taking into account fund performance? For a bit of context there, while the fund returned positive returns around 7.5–8% last year, that was behind the benchmark return. We think mainly due to concentration in return in certain stocks that we either can't own, or sectors that we can't own, or indeed stocks that we won't own due to failing parts of our process. And I think Aziz has covered that in the last few letters. But in terms of lessons, Aziz, what lessons have you learned?
Thank you, Mark, and welcome everyone to our first quarter Q&A. I think there are a lot of lessons to take out of that, and a lot of lessons that I would argue we shouldn't take out of that experience. The explanation before we kind of get into the lessons of what has happened, which is something that I touched on in my year-end query letter for the year 2021. I mean, to start with, it's certainly humbling when that happens. We all know that it will happen time to time, and I'll touch in a second on why pretty much guaranteed to happen from time to time, but it's still certainly humbling every time that it happens. And it's certainly, I mean, I think the word they used in the letter is that it really sucks. It doesn't feel good, because I think part of what drives me, at least, and I'm sure the team every day, is the idea that that a certain number of people have trusted us with their savings and their hard-earned money, and we take that responsibility very seriously. And so disappointing them, even if it's only for 1 year, certainly doesn't feel great, and it's not something that we want to make a habit out of. That being said, I think we talked a lot in the past about the importance of having a portfolio with a high active share. So basically a portfolio that looks nothing like the benchmark, and ours has exceptionally high active share by the standards of the industry. Not saying we're the only ones, but we are in the minority in having active share as high as we do. And it's also a heavily concentrated portfolio by the standards of most of the industry. And so when you have a combination of a concentrated and high active share portfolio, your performance will look nothing like the benchmark in any one period, whether it's 1 month, 6 months, 1 year, or even longer. Now, this cuts both ways. Both positively and negatively. I think it's a prerequisite to outperforming over the long term by a decent amount. The downside of it is that it means that you will have the opposite. You will have periods of underperformance because the portfolio looks nothing like the benchmark. And if the benchmark has a big move one way or the other that's driven by a concentrated number of stocks within the benchmark, which is what happened in 2021, especially the second half of the year, you will miss out because you don't own the 5, 10, or whatever number of names, that small percentage of the portfolio. Some people, many managers, I would argue, solve for that by managing their tracking error, and inevitably that leads to lower active share and lower concentration. Has the benefit of reducing kind of the cost of what we do in any one period, but the bigger loss, in my opinion, is that you lose the opportunity to outperform materially over the long term. And one of our partnership principles is that to only focus on the long term. So we will not make decisions in any short-term period that would benefit us in the short term but hurt us in the long term. In the case of 2021, we happen to not own, like you said, certain sectors of the market like energy and commodities. They're not sectors that we like. Every now and then they'll rally and we'll miss out, but over long periods of time, they will, I believe, underperform the types of businesses that we're interested in. Other things that happened in 2021 that also drove that performance is commodity names tend to benefit earlier in an inflationary cycle, but over the long term, again, we still think quality wins, and history supports that. But then also, we did miss out in 2021 by being too conservative. Now, is that something that we are proud of? I would say it's something that we do. We've always been conservative. We believe that we will miss out, and have said that we will miss out in the last legs of a bull market because we refuse to chase the last kind of drop in the return juice. To kind of mix my my metaphors, but some of these tech names have just gone up too much, and we are not willing to play that game. We're not going to overpay for stocks just because in the short term that may make us look good. We will stick to our discipline in valuation. Now, in terms of lessons learned, I would argue that all of our performance of 2021 happened in the second half of the year. It's a 6-month period. I think often people draw the wrong lesson from short-term moves. We always review our positioning. We always review our process. It's always adaptive, but we're not going to change what we do based on something that happened over the 6 months, or any 6-month period, because we don't think it's necessarily a good data point for the long term. But we did go back to the drawing table and make sure that our thesis on what we own is still intact. The stock that we own are still attractive in terms of valuation and opportunities going forward. We did hold a lot of cash over 2021 that kind of hurt us in the short term, but we are pretty much fully invested now. So holding that cash gave us the opportunity to be ready to deploy all that capital during 2022 to take advantage of the opportunities that we're really excited about that have emerged over the past few weeks. I don't know, Aubrey, do you want to add anything to that?
Obviously, this is something we've discussed, so you've covered a lot of the things that we have discussed together. But I think one thing for myself that perhaps is a lesson I'm still trying to learn is maybe when we sell a stock. And I know that this is something that we've discussed at length, and we probably will do for the next 10 years. But the discipline in selling is really difficult because so often we find that stocks that we've sold then continue to outperform. And is this just us being too conservative, or is there something there? And then maybe the other thing that I personally haven't necessarily been as good at is following stocks once we've sold them. I know that there have been opportunities that maybe we could have come to quicker if we'd been following stocks that we had sold. There is this tendency, I find, that once you've sold a stock, to sort of go, right, I don't want to ever touch that again. And that's obviously completely the wrong approach. And, you know, and that's one of the reasons that we have the bench, and that we've sort of, you know, we've been taking measures to change that. But I think we're getting better at that. That's certainly something that this year brought into focus for me.
Yeah, I think that's a very good point. That's a very good point.
Okay, thank you for that. Second question of the day is, with new voices pushing for a new look towards management, claiming that we're going through an unprecedented economic situation, a new WAM will emerge. Do you see this happening in the domain of asset management? And some of the examples here are emerging assets such as crypto, new robo and AI-based funds. We have always had a US dollar share class. We've just recently released a sterling share class as well. Could we release a Bitcoin share class, for example? Do you think, and I guess to summarize this question, do you think some of the things that we're going through at the moment will lead to sorts of innovation that will ultimately add value to clients, and will Mayar innovate along with it? Yeah.
I mean, obviously, it's a very packed question. I think this is the benefit of I guess, sending in some of these questions ahead of time, is we want to put up a slide, because I want to cover kind of the everything that's changing argument and what you're going to do about it. Let's see if I can share it up here.
While you're doing that, I'll just remind the latecomers to the session that if you want to ask a question, you can do so via the chat function. It'll be anonymous, and I'll summarize questions on the same topic.
All right, let me put up. Can you see my table? I know the font is very small.
1 second. You should be able. The attendees should be able to see the table. There's a number of examples.
Yeah. So this is a table from JP Morgan, and we played around, I think, a little bit with it, but it goes back to 1990 and looks at various events that have occurred since then. So this is a 30-year period, and then looks at the cumulative return of the S&P 500 had you ignored the headline news and invested anyway and held it to today. And so, for example, in 1990, Iraq invades Kuwait, and a recession happened, global recession happened, to a great degree driven by high oil prices. If you had ignored the headline news and just bought the S&P and held it until today, your cumulative total return would have been 2,532%. The Japan asset price collapsed in 91, 2,615. I'm just going to pick a few of these. The ARM in the UK in 92. The Asian financial crisis, again, 925%, so 10x your money. Since then, Y2K, 5x your money. Even in 2000, 2001, if you'd invested, you would have made 4x or 5x your money. A few years, fast forward a few years later, at the subprime blow up 2007, you still would have made 256%. Again, great financial crisis in the midst of it. If you had the courage to just invest and ignore the headlines, you would have made 587%, so more than almost 7x your money. US downgrade in the summer of 2011, 373% until today. The taper tantrum, remember that? You would have made 4x your money if you invested during the taper tantrum. Brexit and Trump getting elected, you would have made 161%. I can go on and on with these examples. Same thing, obviously, with COVID. There is always, here's a list over 30 years of something to worry about that if you just fixated on, you would not have invested. And in many of these cases, if you had invested, you would have had a year or two, maybe longer, of volatile or down results. And yet, if you just close your eyes and held on for the long term, you would have ended up with very respectable results. In fact, I would argue that it's the fact that the headlines are bad that you ended up with such amazing results, because everything was on sale. People were selling you good businesses in the stock market for a cheap price. And if you do that, you end up with a great return. So there's always something to worry about. And that in of itself shouldn't deter you from investing. If anything, should encourage you to invest at that moment in time. So I don't think the fact that we have things to worry about today, inflation or geopolitics or a war, are different. History is full of these things, and over the long term, they pretty much don't matter. What you need to do is make sure you invest in the market and stay invested, and not kind of be deterred by the drawdowns. And I think I have another slide prepared for you that shows the drawdowns. They're part of what you have to withstand. I mean, just look at that red kind of inverted mountain in that chart and see how painful these drawdowns were. And I think at the time, you probably would have felt terrible, feeling that you've lost 20% or 30% or 50% of your money. And yet, if you just close your eyes and held on and done nothing, you would have ended up with riding that amazing compounding chart all the way upward. And that's just the history of markets. They will be volatile. The best thing to do is to stick with your strategy and not try to time the market or try to exit. Certainly don't try to exit when the headlines look bad, because that's usually the worst time to exit. If anything, you should add if you have the cash during these periods. And then this is kind of, I've written about this before. This is why I personally, for individual investors, I'm very positive on a dollar cost averaging approach, where you invest a fixed amount of money every month out of your savings into, even if it's something as simple as a MSCI or S&P 500 ETF, and then just stick with it. Just stick with it for the long term. Too much investors create too much damage to their portfolio by trying to get in, get out, worry about the headlines. What should we do now, or shouldn't? I have one more chart to share with you on this topic, which is it just shows you how much damage investors do to their portfolios. So this looks at, it's from a study from Morningstar that looked at the performance of U.S. mutual funds over a 30-year period and compared it to the performance of the actual investors in those same funds. So what in blue is the fund performance, net of fees, which is basically if you just bought the fund and held it for 30 years. And then the red is the performance of the average fund investor. So this is what the investors actually achieved by trying to go in and out and time the market. And you can see that over your savings lifetime, in this case, you've lost so much money. And in this case, about a third of, actually more than a third of your cumulative gains as an investor by trying to go in and out, in and out, on and out of the market to try to be smart about it. The reality is no one can do it. It cannot be done. If you have cash in bad times, invest it. And that's often the best they can do in terms of timing, because the market will be down and you know that it's down. But don't try to predict it and try to get out and get back in. This proves to you that the average investor can't do it. And I would argue even the most sophisticated investors are not good at doing it. You're much better off being sensible and either doing a dollar cost averaging, or if you want to do any kind of timing, what you want to do is basically, to use Buffett's metaphor, be fearful when others are greedy, and be greedy when others are fearful. When we're at times where people are panicking and worried, that's the time to invest. And but I wouldn't be selling in other times, because you're riding this compounding machine. That's the beauty of being invested in equities over the long term. And it just, don't step in front of that compounding machine and try to hurt it. We can see how much damage you can do to your portfolio. So that's going to be what's in the news answer. I think we could take this chart off. And Sorry, can you still see me?
Yeah, I can see you now, I think.
Okay. And then the other thing on the issue of crypto, AI, GBP share class, Bitcoin share class. I think in crypto, I think we've answered this question many times. My answer hasn't changed. I don't think it's an investable asset. I obviously can be proven wrong and have made wrong bets in the past. I still think this one is one we're pretty confident about over the long term. Is it impossible that I am wrong about it? No, it's not impossible, but I'm pretty confident that I'm not. But history will show whether or not I'm right about it. I do think that it has had an impact in many ways. I think the people are realizing a lot of uses to a lot of technology has been underlying a lot of these things. It's driven down the cost of many technologies that have many other uses outside crypto, and that's a good thing. And often that's the case, actually. A lot of bubbles do drive technological innovation. Investors get hurt, but humanity overall benefits. And I've written about this in previous letters. And essentially, it's the mania subsidizing future consumers in some degree. AI Robo Advisors. I think AI Robo Advisors has democratized access to the portfolio diversification and tools to many people. That being said, from what I've seen in reality, I would say at least half of those so-called robo advisors are not doing any kind of real AI or anything fancy like that, and they just have fancy apps with pretty dumb technology in the back. So I would say choose wisely and know what is it that you're paying for. But I do think that it like a lot of technology, it has reduced the cost of investing, it's cost of reduced of trading, cost of reduced of many things. It's a double-edged sword. Lower trading costs save long-term investors a lot of money. I'm certainly very happy about the brokerage fees that we pay today compared to what I used to pay 20 years ago. But also we've seen from Robinhood and other platforms, it can also drive silly behavior. So it's a double-edged sword. It's a tool. Use it to your advantage. Don't take it as an excuse to do dumb stuff like day trade online all the time. Will we create a crypto share class? No. That being said, I wouldn't be surprised that some form of the technologies that are being used in crypto, I would suspect, I think a lot of it is actually pretty useful and a good fit for shareholder registers in companies and in funds. And there's a lot of friction, as I'm sure many of our shareholders know, in kind of subscription redemption out of funds. And I think I would urge administrators and transfer agents in the fund industry to try to use some of the technologies that have been innovated by crypto to try to make this process smoother. And I suspect that a lot of it will come to the industry at some point, at least once that technology matures, because I do think it's a good fit. So essentially, what you will have is fund units of any fund can become tradable like crypto assets in the future, but they're backed by units in a fund or a currency or whatever it is. So you're not creating a real cryptocurrency, you're just utilizing the blockchain and other technologies to make the process of subscribing, redeeming, and transferring units much more easier than what it is today. So there's a potential use to it, but I don't think we will denominate a share class in a cryptocurrency. I know I've talked a lot. Maybe I'll send it to you. Maybe, but anything to add?
Thanks for that, Aziz. I just want to bring in another question that we've had on the chat, so thank you for that, regarding use of cash and relate it specifically to the fund's use of cash. It's been commented on numerous times over the last few years that sometimes the fund has relatively high cash balances and sometimes we have cash in the region of 20%. Is that a considerable amount of cash for what is ostensibly an equity fund?
Well, that's an excellent question. And I think in a perfect world, we'd be fully invested all the time, because as I just talked earlier, it's not smart to try to time the market. So I assure you, we're not kind of making a macro bet or a market timing bet trying to say, oh, I want to have 20% cash or I want to have 15% cash, whatever the number might be. What ends up happening is, as Aubrey talked about a few minutes earlier, in addition to our portfolio, we've got our bench. Essentially, we've got a set of multiple opportunities that we are either looking at right now, or things that we like, but they are trading at the wrong price or not, so they're not attractive to purchase at that moment in time. And then everything that we own also has a potential sell price. If Mr. Market gives us a silly price, we'd be happy to sell it. And so when we find more attractive things to buy, which tends to happen in times where there's a market disruption, you'll see that our cash goes down. And that's what happened in the past 2 weeks, for example, actually the past 3 months, especially. And at other times, we will find nothing interesting to buy, and we'll have to sell some things because we don't like them anymore, and the cash goes up. And so the cash is a byproduct of our investment process. We stick to our process, and we're disciplined about it, and the cash is the outcome of that. And time again, what you see, I mean, and I'm not trying to predict returns or anything right here, but in late 2019 into 2020, we also had like 20% cash because we thought there was a shortage of investable ideas that we liked. And then COVID happened, the market dropped, we were able to deploy that cash fairly quickly. So we went from 20 to 15, and then in the late March, we went to pretty much 0% cash. And in 2021, we had 20% cash late 2021. In, I think, January or February, it dropped to around 15. And now with the market where it is, we're pretty much fully invested, actually. We have one trade that's working in the market right now. If it fills, we will be fully invested. So we don't like to have cash. Cash is a burden, especially in inflationary times. But we won't break our discipline and valuation just to solve for lower cash in the short term. Over the long term, for most of the fund's life, you will find that we tend to get to that fully invested period at the right time of the cycle by virtue of our valuation discipline. Aubrey, you have anything to add?
No, not particularly. I mean, as you say, it's a function of the process, and there are ideas now, and we're finding them, and it determines our geographic allocation as well, because we don't sit and make a conscious decision we like America over Europe. It just naturally happens that if we find ideas that we really like in Europe, if they hit our price targets, that's when we go there as opposed to America.
Yeah, I think that's a very good point as well. Yeah,
it is a good point, and it's one that I hope answers one of the questions that we've had in. What are the reasons for your US underweight versus Europe? And it's typically one that is built from the bottom up, if I'm reflecting the process correctly. I'd just like to move on to emerging market opportunities, if I may. Some emerging markets in the region and Middle East, North Africa, like Egypt, for instance, have lots of value, although we accept that it comes with its own risk. Are these options away for the fund, away from the Europe and US? And sticking with the emerging market theme, there are a number of Chinese stocks listed in the US. Could these be options for the fund as well?
So I'm less concerned or driven by where something is listed. I usually like to think of things based on two things. So from a governance point of view, where you're domiciled and where you operate matters. And then from a risk point of view, where you sell things and where you make things, I think matters. I would say the listing is to a lower importance compared to these other two factors. I think in general, in theory, kind of there's this risk reward kind of curve, and in theory, at each point of risk, there's a price where you should buy, right? No matter how risky it is, there's got to be a price where it's a good bet. Kind of that's the theoretical, I think, foundation, and I agree with it from a theoretical point of view. In practice, what we tend to do is we basically truncate that distribution and say we will not accept risk beyond a certain level. And so we are risk averse by nature, and you can see that in our numbers, you can see it in how the portfolio behaves over time and the behavior of individual names. So even if the price is right, there is a point of risk, I admit, where even if theoretically you should be buying, we will not buy something at that risk level. It's not the right, at least thing for the fund or our portfolios. But I do understand why, from a theoretical point of view, if the price is right, even something with super high risk is probably worth buying. So a lot of emerging market stocks fall under that prism of basically the risk is too high. Another group, I would argue, falls into the too hard pile, or there are just too many factors that are very hard to predict, whether it's currency or a sovereign balance sheet or the local economy and capital flows, and there are just too many things that could go wrong for our taste. And the third part, I think, is often what you see is in most emerging markets, and by no means all, and I'll tell you some exceptions, the governance is just too poor for our taste. We've always been very interested in governance and making sure that the right structure is in place. We use governance and accounting as a way to kill ideas. That's the first filter that we use to kill ideas quickly, and we've talked about this approach in the past. And then just many companies in emerging markets don't pass that filter, unfortunately. It can change. And it does change, and every now and then you'll see that we do own some emerging market names for one reason or another. But basically, when we do, the opportunity has to be very attractive, far more attractive than an equally than a similar one in developed markets. So there's always going to be a higher risk premium and a higher return required from investing in them. And often you will find that there is something unique about it from a risk perspective that makes us feel like our downside risk is managed. In general, like I said, our mandate is developed markets. We are allowed to invest in emerging markets sometimes, in exceptional cases when we find these opportunities attractive, but we don't usually hunt there, to be honest, just because the majority of the time is just too hard and too risky, and it's not something we want to do. I know, Aubrey, do you have any additional thoughts on that?
Yeah, I mean, there's a phrase I heard someone use I really liked, which is return on brain damage. And you as investors want us to deploy our resources as effectively as possible. And I'm not going to talk about brain damage here, but if we're going to say that investigating one stock which is based in Egypt, whether it's going to take up a huge amount of time and resource, actually we're better off maybe sometimes finding stocks which have similar return profiles, which are easier. If you say, look, in this hunting ground, in this fishing pool, you've got lots of ideas which you're going to be able to easily understand, then you're obviously going to go to that one than the one that has, the same return profile but is more difficult. As you said, which pool do you go to fish in? Well, the one with lots of fish that where they're easier to catch. So I think that does play a part.
Okay, thank you very much for those answers. I've just noticed we're over the notional 30-minute limit, but if we could just stay on the line for a little bit longer to talk about a specific stock, namely Dropbox, where we've had a few questions related to that. If I could summarise it, is if you can give some colour on the possible catalysts. What's the size of the moat given the position Mayar's allocated to it? Does Dropbox have enough pricing power to weather the inflationary storm? And Dropbox has been managed to grow revenues roughly 12% on average, but while reducing capex. And why is that phenomenon occurring? And is it something that can be maintained over the medium to long term?
I think I want to send this to Aubrey, but while we also, I think Aubrey has prepared some slides for this with the investment team. See if we can get it up from here on the screen, and then Aubrey can comment on it. So Mark, if you can move, yeah, if you can move Aubrey into frame, and then
yeah, but of course,
see if we can share. If not, we can keep it on. No,
Aubrey, you can, you're on screen at the moment, and I'm happy to send the slides to the screen at your cue.
Okay, brilliant. Well, let me first just tell you a little bit about what Dropbox is and also what it's not, because I think a lot of people, and including a lot of us, didn't really understand what it was. Dropbox give away all this free storage, and it seems that that's what the market focuses on, and that's what they think it is. However, I use Dropbox for music, and I believe, Mark, you also use it for music. You can perhaps in the background, I've got a few guitars, and I know you do as well. And the big difference here is
Mark, I'm told people can't see the slides. Sorry, Aubrey, to interrupt.
I think Aubrey is just preambling at the moment, and then the slides will come in a second.
That's a very kind way of saying waffling, but but to get back to my point, in my day job, the biggest file I ever see is maybe 40 megabytes, 50 megabytes, and that's a really big Excel file. That's a model that, oh God, I don't want to talk about that. But in music, a big file might be 2 to 3 gigabytes. A big file would push through the free allowance that Dropbox give you. But not only that, if I want to share that with a producer in LA, for instance, that can take a long time if you're using Google Drive. Whereas if you're using Dropbox, they have some really cool technology that allows any change I make, they only transfer the change. So it makes it so much more efficient to share files. And then by sharing files amongst people in media, people using really large videos, photographs, you then start to create a network effect, which is beginning to start to answer about the moat. That when we separate it from the free users and the paying users, we suddenly realize that actually it's a very different, it's not just a different client base, it's almost a different service, because you are buying the file sharing, you're paying for the file organization. There are a huge number of things that you're paying for, way above just the simple commoditized storage element that people are getting for free. So I think that's the first point that we really need to understand. And then that almost then answers some of the next questions about pricing power and about the moat. But then the question on CapEx, if we can now show the slide.
Yep, that should be in the screen now.
So we can see that there was a CapEx hump in 2016 and another one in 2019. Now, these were related to, in 2016, build out of data centers, which they actually leased, but they built some of the technology. So as you can imagine, you get that little hump there. And then in 2019, they refitted their head office. So again, you get a big one there. But CapEx really is a very small part of their investment. The actual R&D is the most important part. Now, if you think about it in general terms, the CapEx is when you spend $1,000 on a computer. The R&D is the $100,000 you pay to the developer that develops the software on that computer. So there is just a massive difference in terms of, that's why you're seeing the R&D budget being so much bigger. But they're both investment. It's just how do we classify that investment? One through the cash flow statement and one through the income statement. But they're both investment. And as you can see, on the chart on the right, they have stepped up and actually kept it fairly level at roughly 800 million. Now, obviously, that has declined as a percentage of sales, but that's really just, that is what happens with scale. Do you have anything further to add on that, Aziz?
Yeah, maybe just something small, which I think I wrote about this last year. And I think this is kind of one of the issues that many value investors have grappled with in the past, which is you have the economy has changed in a way where you really need to look at investment as a total amount instead of just looking at that CapEx line. And as you see, this is a perfect example where a lot of investment is run through the P&L instead of through the cash flow statement. And you really need to look at the total picture and both value the company, but also understand the underlying dynamics of their investment cycle through the lens of the total combined investment spending that they do, and not just through the CapEx. We're not saying that we should exclude the R&D number, for example, that it's not an expense, but it should be treated as investment and seen through that lens. And we do value companies by adjusting these things so that we're looking at a company that has a lot of R&D versus a company that has a lot of CapEx in the same lens. You would amortize the R&D over a shorter period, depending on the kind of the business versus kind of a building. But in the end, all of them are investments, and you need to look at whether it's the return on that investment, the valuation, the actual profit margin and return profile on an incremental basis of that business. All of these should be looked through the adjusted lens in order to compare apples to apples.
Okay, well, thank you very much for that. We haven't had any further questions, so I think we'll draw a line under that there. Just leaves me to thank both Aziz and Aubrey for presenting, and of course everyone for joining. We'll look forward to the next version of this after the next quarterly letter is released. But until then, thank you everyone for joining. Our door is always open. Please email questions to ir@mayarcapital.com. That's the best way to access the team. But for now, we'll say goodbye. Goodbye.
Thank you very much. Goodbye.
Goodbye.